This is a story about a dude named Lane. He moved to the mainland and bought one place to stay. And then one day he went try to rent them out. And then he became one real investor man. Hey everybody, this is Lane with the Simple Passive Cashflow podcast. Please leave an iTunes review and go to simplepassivecashflow.com and click on the Deal Pipeline Club link so you get signed up for all the deals that I come across. And I will send out emails when I come across something that looks good. Today on the line, I have Sep Bekam. How's it going, Sep?
Hey, good, Lane. How are you?
Pretty good today. I woke up early, did the Hui Pipeline Club newsletter, and they analyzed some properties, worked out, went to the float, had 10 more things to do today, and gonna get a massage later. But the difference between you and me is that I have to go back to work Monday and you don't.
Well, you get the massage though, so it's a pretty good trade-off.
Sep is a full-time real estate investor and was able to get out of the rat race when he was 31 years old. He continually invests in 4 states and acquired a portfolio of 50 houses and 80 apartments with his investors. Sep has interviewed twice on the Real Estate Guys radio show and recently co-founded a real estate crowdfunding company. He enjoys helping other investors avoid making the same mistakes he did when he first got started. Sep, anything you want to add to that?
Well, it's I'd like to say that it was simple and passive, kind of like when we talked about offline. One of your previous guests had mentioned that his experience was anything but simple or passive, and my experience was very similar. So it was very active and complicated, but I think there is definitely a formula to it. So I hope to be able to share that with your listeners.
Yeah, I know one guy sent me an email saying, hey, the Simple Passive Cashflow podcast has turned into the very active investor podcast. But we're trying to get to the passive side. I think that's the whole way we're going with this.
Right.
So, Sep, how much Simple Passive Cashflow are you making today, and how are you doing it?
So currently it's in the 6-figure range, and most of what we do is long-term buy and hold investing. We did do a couple flips recently, but I think especially with the new acquisitions in the pipeline, it'll be able to be more, provide more cash flow for the investors and for myself. So the goal is to make it 100% of the passive.
Me and you met last year, and you've kind of been I don't know if you realize it, but sort of an informal mentor to me. I've been kind of following your footsteps in trying to quit my day job and go full-time real estate investing. And you were also an engineer, right?
Yeah, electrical engineer, actually.
And you and I sat down one day in California, and I remember you told me that when you finally quit your day job, you had so much more free time and everything just progressed way, way faster. I always remember that. It's something that, just made total sense to me.
Yeah, and I think a lot of times we get focused more on the numbers than the lifestyle and those extra hours that we have in the day, which is equally important.
So, Seb, what is your Han Solo moment? And for people who don't know what that is, Han Solo and his buddy Chewbacca from Star Wars were cruising the galaxy as low smugglers, but then crossed paths with Luke and Leia, and their lives took a pivot point. So, Seb, what's your resistance that you came across, and what was the catalyst for the change to finally burn the boats and follow the path that you are walking today? And it looks like you never looked back from the day job, right?
Yeah, I love that question, Lane. Well, unfortunately, I didn't have a Chewbacca by my side, so I didn't have a partner or a sidekick to kind of help, fight off the Empire and all those battles. I felt like I was working for the Empire with the day jobs at the time. So just a little background: I live in Orange County, graduated with my undergrad back in 2008, got a job immediately afterwards, and I thought once I'd have that job, I'd have a lot more time to go travel, go paintballing, do a lot of the things I had on my goal sheet. But it ended up when I realized that this is how much time I would be trading for the next 12 months or years and years for this paycheck. I literally had to cross off goals off of my list, which is the opposite of what we're supposed to do, right? We're supposed to add on to it and establish the game plan. I just didn't feel like I had control. So it was ironic because I saw the movie Office Space back when I was in high school, and I thought I didn't think real companies like that existed. But even the company I was in, they literally had TPS reports, and I think they they thought that they were making fun of the movie or just, trying to be playful with it. But everything about it was just like the movie. I mean, you just have the kind of that draconian boss breathing down your neck and not really caring if you're happy over there or you feel like you're making a difference. You get ridiculed if you ask a question or if you try to help out another employee if they're running into some issues. I just felt it was very competitive. It wasn't like what I'd imagined, like working at Tesla or Apple or Google. So it was just pretty stressful. And this is back in 2008. So at the time, as a new college graduate, I didn't really have a lot of options. And then when the recession hit, I got laid off. I was actually laid off twice from the jobs. And it was, I just had to keep looking for new jobs every time. And I was basically at the mercy of the employer. This is how much we're going to pay you for your time. And it was never really a 40-hour work week because especially if you go on salary, you got to get the job done. So it could turn into 50-hour weeks. I mean, I would come in on the weekends to make sure that projects would be finished. And then you kind of get to that ceiling. And I remember asking each of my bosses, what else can I do to grow within the company? And I felt like kind of school was the only other way. So I went back for my master's.
And what year did you graduate your undergrad?
That was in 2008. So I'd switched majors a couple times, but then I continued my master's about a year and a half afterwards.
Yeah, that's interesting because I graduated in 2007. So by the time the recession hit, really in 2009, was when all the tough times came. I was sort of established, but it seems like you were right on that new chopping block when you came out at 2008.
Right. Especially
maybe that was the best thing because I was working for a very stable company and I had the most stable job that I could get, whereas you were on the chopping block, and in hindsight, that was the best thing, huh?
Yeah, it's I mean, kind of looking back, I was kind of glad that it happened. The first company was related to kind of defense industry and military industry, and when it changed from Bush to Obama, it wasn't as lucrative to be in that business anymore. I mean, it was a different captain on the ship. And then afterwards, the next job was related to the housing industry. And it was a great time to be buying investment properties. I thought that you'd have to have a lot of money. You'd have to have $1 million to go buy real estate. So I got stuck into the stock market. I was just saving whatever I could from that company. And my coworker told me he had a rich uncle that had made a lot of money in stocks. And he said, Sep, you got to invest in this company called Washington Mutual. And I put all my savings I had at the time in that, and I got burned so bad that I was like, all right, enough of that. I'll just save up for down payment for a rental property. So I didn't really I didn't know how that would be. I just thought in order to get that rental property, I have to go to another bank that was still in business. And I went up to another major bank, and they asked me how long I'd been working for. They wanted me to show them my W-2, the pay stubs and all that. And what they qualified me for was basically enough to get like a 1-bedroom apartment in Orange County, which, where I live. So nothing would cash flow, and it would take a significant down payment. So I was discouraged and, went back to school for the master's.
I mean, you had an engineering job, which is a pretty decent job. What were you netting at the end of, you made the money and then at your day job, and then you paid all these expenses, your rent, your car. Something I talk a lot about with people that call in from the podcast, and we talk about strategies. What were you seeing?
Right. Well, at the time, one of the goals was to be able to move out. So I moved back in with my parents to save money to be able to afford a house that I can buy and then have some roommates. I didn't have the car payment, and I saved. I tried to max out my 401k, just, take any deductions that I could, which, as you know, if we're just an employee and we don't have rentals, then we're pretty limited in terms of what we can do to mitigate our taxes. So I was just, being frugal for a while. And for about a year and a half after that, I was saving, and I was just pretty stressed out. I was going to work. I was working about 45 hours a week, spending about an hour a day in traffic. So hour and a half, I should say. And then going for school for the master's, I didn't get a chance to, I felt like I didn't get a chance to have any fun, have a social life even on the weekends. It was just work, school, work, school, work, school. And I remember seeing my cousin about halfway through the master's at a family get together, and she asked me, what is your goal? She was a dentist actually. And I said, well, ultimately I want to get this master's so I can have a little bit more money and contribute more to the company. But down the road, I'd like to start my own company. I just don't know how. I don't know if I need to get an MBA. If I need to go study business. And she asked me if I ever heard of Robert Kiyosaki or read any of his books. And I said I hadn't. And she recommended, instead of starting with Rich Dad Poor Dad, she recommended I start with his new book at the time. It was called Conspiracy of the Rich. And the one thing that she left me with, that it kind of felt like that moment from The Matrix where Neo has a choice between the red pill and the blue pill, is she said, did you know that the Federal Reserve is neither federal nor reserve? And I was like, you're kidding me, right? That doesn't make any sense. Like I'm working for these dollars, and every single dollar that I'm working for, it says Federal Reserve note. She's like, go research it and then read the book once you find the answer. And I just pondered for a second. I was like, how is that even possible? How is it that the Federal Reserve, this government agency, which, or at least I thought it was a government agency, how can it be not even, it's not a bank, it doesn't have any reserves, and it's not even federal. So I read the book, and it answered that question, and it got me asking a lot more questions. And Conspiracy of the Rich, that Kiyosaki book, it's not really a real estate book, but it does relate real estate to as a solution to the problem. The problem is inflation, right? Robert Kiyosaki believes that the Federal Reserve is a big part of what led to the financial crisis. I mean, there was sloppy investing in Wall Street too, but there was a lot of easy money at the time. And the book just kind of showed the history of the people that got hurt the most during the recession were the ones who were investing for speculation. They were investing for capital gains. They weren't investing for cash flow. And the ones who did invest for cash flow, they could weather that storm much better. So it was a big paradigm shift for me, is because I kind of got spooked too. It was like, this inflation is happening, and if the value of the money that I'm earning goes down every single year, and if I'm not getting raises because my bosses keep saying the economy is bad, we're in the middle of a recession, sales aren't there, then I'm actually losing money. Even if the wages stay flat, I'm losing money basically. It's just there's more and more money. QE at the time was QE1, QE2, QE3. So I got that burning desire. That was the catalyst, back to your earlier question, to get into real estate, and just to from there, read Ken McElroy's book, ABCs of Real Estate Investing, gone to the podcast, The Real Estate Guys. I've listened to all of your podcasts as well too, and I'm always reading books and going to the seminars, and kind of from there just led on to the real estate investing journey.
Yeah, I guess kind of going back to what you're saying about inflation, the way I see it is it's kind of an insidious way of robbing people's savings. I mean, you buy a house for, what we're doing is we're buying a house for $100,000, but that house will probably be about $300,000 by the time 20, 30 years from now. And we're paying it back. We're still paying back that original $100,000 note. And it's just the normal people just don't realize that the government's robbing them every year with inflation, and they're manipulating the inflation numbers.
That's true. And it happens so slowly too, right? It's not like it, and that's when I remember when I first learned about that, I got so excited. I told my friends, and they thought I was crazy. It was like, okay, yeah, inflation, it's a little bit, but they would reference like the CPI, and just talk about how, well, CPI is only like 1% or 2% of the time. But it doesn't include food. It doesn't include, the necessities, that are actually affected the most by the inflation, basically. It counts iPads and iPhones and all that, but those naturally go down in value. And the neat thing, you were talking about 30 years ahead. It's interesting too to see the value of real estate 30 years before. Just even the cost of construction, all the commodities that go into construction of any type of real estate, those commodities go up in value over time. Like the wood is not getting any cheaper, the copper is not getting cheaper, the tar that goes to make the oil that goes to make the roof, and the labor that takes to apply that. It's kind of like we're buying these raw commodities and hedging ourselves up so that as there's more money being printed, we're being able to basically ride the tide.
Right, and if you and I were politicians and making laws, it's a great idea, right? Just people don't realize that they're taking their money with inflation. Like out here in Seattle, I think you got a lot in California, there's toll roads, right? And people go crazy over that stuff. And I just think to myself, like, why don't they just like not do any toll roads so people don't get upset about, $5 here and there, but just get them on the inflation, because people don't even know what happened to that money.
Right. And you add on to it too. I mean, just, the politicians, not to get too political, but, our national debt, it's $20 trillion, right? So that's a fact, and it's growing. So it's, and it's you, me, and everyone else that's going to have to end up paying for it one way or another. And it's not likely that the government's going to reduce that. They're probably just going to keep doing what they did and just devalue the currency and make it so that 20 trillion feels like 20 billion. Just more and more paper money or fiat currency floating around.
I think politically, you and I are just too busy to even have an opinion.
Probably right.
So you started with these single family homes, and then you let's just take a step back. How much did you save for that first one?
Well, that was interesting. So I actually didn't start with single family. After I read that book, I probably had about 80 to 100,000 saved. And then I read the Ken McElroy book, ABCs of Real Estate Investing, Real Book of Real Estate, Multifamily Millions, and all that. So I got the real estate bug, but it was more lined towards apartment buildings. And back then, I wasn't aware of like seller financing or the creative strategies. So I got into I was still listening to the podcast every day during the commute, and there was one particular podcast. It was a turnkey provider who kind of opened my mind up to going out of state and going basically where the numbers make sense and where there's that population and job growth. The problem was I think I overtrusted them. I didn't know what the difference was between a good turnkey deal and a bad turnkey deal. I just, they provide the pro forma, and unfortunately I believed it. So the pro forma said that these two properties that I was about to purchase would cash flow, I think it was something like $8,000 a year, and I got really excited, and I was planning on reinvesting that cash flow. So the two properties ended up being two fourplexes, and the market was in Phoenix, Arizona. This is back in December 2010. And it was kind of to my surprise, after we closed, it took about just over 2 years to get those two buildings to cash flow, because it was eviction after eviction, vacancies. Tenants would move in, they move back out after 2 months, and they wouldn't leave the property nice and pristine. They would bash the windows, they would knock holes in the walls. I didn't even know it was possible refrigerators could get that dirty, but it looked, a white refrigerator would turn black just with all the mold and all that. So it was kind of pretty nasty and stressful, because I basically put all my money into the down payment for those two properties. And I was dealing with all the property management headaches along the way as well. And
that's what I call these turnkey providers. A lot of them will see the California investors or Seattle investors, and we're not there. So we really put a lot of faith in them. And that's why I started helping people buying turnkey rentals, because I got sick and tired of people not really knowing what they're doing and not using a broker too.
Yeah. And that's a good point, because the turnkey providers and the flippers, they're not all bad, but their financial incentive is they make money on the purchase, right? They have no incentive to make sure that the property cash flows. They have no incentive to make sure that there's a good management team in place. They can say they do, but they don't make any money off of that, right? So they give attention to the spoon that feeds them. And I think that's the big difference between that route and going with a broker. And the next level is with the syndicator, right? Like the syndicators, they get paid only when the property cash flows, if there's like a preferred return or on the back end. So they have a vested interest to make sure that deal performs, and so that the investor is not just left with a hot potato. I didn't know, at the time it was just I kept the wrong management companies in place too long. And I notified the turnkey provider, and they'd messaged the property manager at the time that came with the property. It was just, kind of lip service. So I went through another company and then another one, and then I finally started getting it stabilized. But even while I was negative cash flowing, I kept buying properties. I realized that there had to be a solution to it. I was doing something wrong, but it wasn't the property's fault. Like these buildings have been around since like the 1960s. I'm sure that they had been cash flowing from before, and once I could solve that problem, that I would basically get the reward. So add value first and then get paid after.
So how many did you acquire, and how much passive cash flow were you up to before making the jump?
So from there, those two, I did another fourplex, and then then I ran out of money. The third fourplex, I just bought it with a credit card, and that one ended up having a meth lab. It was a meth lab. There was a sex offender living in the property, and then the property manager, when they found out it was a sex offender, they asked if I wanted to manage it. It's like, well, why am I paying you guys? And what am I going to do? Take a phone call and deal with all those hassles with that and all the issues you can provide the other tenants. But one by one, I would get them stabilized, and then did a sixplex that was as a syndication, and then went on to do a 52-unit apartment complex. So after the 52 unit, that's when I got out of the rat race. And that deal was about 2 years. Actually, no, that was about 1 year after I bought it. I was able to get out of the rat race. And we were about halfway through the repositioning on that one. So that was December 2014 when I fired the boss.
And I think you mentioned to me that you really didn't have that much passive cash flow at that time. You kind of just took the leap, right? Like you were at, what, 3,000 or something like that?
Yeah, it was pretty low. And that was that barely covered the expenses at the time. Kind of like the Cashflow 101 game, which it's great if any of the listeners haven't played. If you get a chance to play with Lane too, it's awesome. When the game, you have to have passive income greater than your monthly expenses. And even though I was close, I knew that if I didn't have to deal with just the stress of the job, the commute, and 50 hours working for that company, if I could just put that into doing 3 more deals or 2 more deals, and they don't have to be big deals, but just small deals to get a little bit higher, that it would be worth it. And it ended up being the case. Like about 2 months after I got out of the rat race, bought another 4 properties. 6 months later, bought another 8 houses, then another house, and just it was kind of like that compound effect. If looking back, I wish I would have gone out sooner. If I had the reserves, I would have been okay with that negative cash flow at the beginning. But this is a little bit more of a riskier strategy. It comes down to personal preference.
And that was all with syndication money, or not syndications via SEC, but just private money lending.
Exactly.
So how did you structure those deals? Because you were the experience, you had the deal flow, and then people were just. I mean, people think that they have money, and money is pretty easy to find when you give them pretty good return. How did you structure it initially? Yeah, well, at the beginning, I was really embarrassed of the problems that I had on the properties, and the ongoing problems too. The meth labs, the drive-by shootings. I mean, I didn't realize that a lot of these properties were D or F neighborhoods until after I bought it. Because I mean, even like the difference between a C-class property and a D, they can look very, very similar. The difference is if you have one bad apple tenant in that apartment complex. If you have one drug dealer on there, all the tenants near them are going to move out. They're going to tell the rest of the neighbors in the property. Then that drug dealer is going to attract the wrong client, attract the wrong crowd and the wrong customers. So it can turn pretty quickly. But it was a good lesson because that helped us as far as vetting out the property management companies, make sure they can prevent that from happening, what to do when that happens, how to vet the tenants correctly, so we're not dealing with that constant turnover. And it was embarrassing, but I found that whenever any of the investors would ask, like, hey, how are your current properties doing? I would just tell them, they would get scared and shocked because they thought once you have real estate, it automatically cash flows. It automatically that there would be a line of tenants waiting to get in there. And they realize it's a lot more challenging than what the turnkey providers make it seem like. It is a business. We are providing a product, that housing, but we have to market it. We have to make sure that the customer service is good. We have to make sure that there's a team in place and a system in place to be able to answer any of the after hours maintenance calls. And this goes for any type of rental property class. But when they found out all the different moving pieces in there, and then that there was a system in place to be able to manage that, they got excited and were more open to partnering up. So when we were talking about earlier about simple and passive, it wasn't simple and passive for me, but what I get enjoyment out of, and I could tell you do as well, is making it simple and passive for others, because not everyone has the time to read the books, go to the seminars, or have the conversations and make the mistakes. They'd rather just get the benefit and work with other people that are already doing it and have those systems in place. Would you be able to share pretty standard partnership ranges? You know, if you bring in the deal and you operate and manage the investment, how much would the investor be expecting to make? Or is it like a 50-50 split, or what's the kind of methodology there?
It depends really on the investor. I've tried, I've underwritten a lot of multifamily deals along the way. And initially when I would come across like a deal that I want to syndicate, it's like once you get that deal, if it's a 100-unit building or however 200-unit building, whatever it is, like the clock starts ticking. You put in your earnest money deposit, and that money, it could be $10,000, it could be $100,000. It goes hard after 30 days or 45 days. And if it's in a really competitive market like Dallas, you have other investors that they're able to put non-refundable earnest money. So that money is hard the instant the seller takes it. And that's really hard to compete with. Because we want to make a non-biased decision. We want to make sure that we're not attached to the deal, that we're looking under every rock, and the team is making sure that mechanical, electrical systems are good. Doing the lease audits. So I felt that when I would start with the deal first and then try to raise capital for that deal, I'd feel like a car salesman, like a used car salesman, because I didn't take the time to figure out what the investor was looking for. I used to think that all real estate investors wanted the same deals that I did, but even when I came across some really sweet seller finance deals on multifamily with big upside, as soon as the investors would see the current status of that property or how it currently looked like, they would just get too, it wouldn't meet their tolerance or their criteria. Like the pain of dealing with that outweighed the benefit. So I felt that if I start first listening to the investors instead of trying to convince them, and instead of trying to sell them anything, but just listening to them, find out what else have they done in the past, what do they want real estate to do for them? Do they have a tax problem? Are they wanting to get more depreciation? Do they want cash flow? Do they want more of equity upside? Is this retirement money? Is this money to pay off for their kids' education? Once I know that, it may or may not even be my deal that can solve the problem, or maybe the best solution is for me to point them in the direction of someone else that has that prescription, if you will, that can solve their particular pain. So structuring that way, I mean, some of the investors like debt, we take it up to whatever the usury limit is, state by state. Other investors are looking to, double their money in X number of years or offset those tax issues. So it's really case by case basis.
Did this kind of dictate you going from apartment complexes to pools of single family homes, or is it another thing going on?
Yeah, I still love multifamily. It's and it did because I felt even some of the investors I worked with that they're really, really great, easy to work with, but they would only want to be in a deal, say, for like 12 months. Like they cared only about short term. Like they just want to be liquid, and they wanted to have that security of being able to foreclose on a property if worst case scenario happens. They weren't really interested in being in a deal longer term, and other investors were. So seeing what some other friends had done in Atlanta, who started around the same time as me, they were able to gather rat race with like half as many units, and it just felt like everything was happening exponentially faster with them because they were focused on a different asset class. And it was kind of a hard pill for me to swallow because I always felt like multifamily is always the best, and I see most single family investors wanting to go into multifamily. But it has to be in alignment with their investor identity because multifamily, there's a lot more efficiencies. You have, you can have the on-site maintenance, on-site management, economies of scale. But at the same time, kind of like what Ken McElroy shared at one time when we were in the seminars, you could have a tornado go through there. And if you have 50 houses, that tornado might wipe out one or two houses. But if it gets in the path of one apartment complex, you can have the entire thing disintegrated. Or an ice storm. I think it was like Jorge Newberry had mentioned before.
When I got smart and sold my primary residence to start investing in investments that actually made sense, I needed a place to diversify quickly as opposed to some money market or some high reward checking account. Let's face it, turnkey rentals are cool and syndications are great, but they don't come around often. I stumbled upon the American Homeowner Preservation Fund. The owner, George Newberry, once apartment syndicator too, is now sponsoring the podcast. His fund cuts the middleman out to crowdfund the solution to the mortgage crisis in America. They empower you to fund the purchase of distressed mortgages and earn returns that smoke any other passive fund. If you find something else better out there, let me know. Oh yeah, they work with families to keep them in their home after buying the underwater note at a huge discount. It's an opportunity to make an impact on families and communities while earning returns. Start investing with as little as $100 in investinahp.com. If you want the free Burn Zone book, please send me an email at lane@simplepassivecashflow.com.
I look at it as it's just one prescription. What I like about the single family portfolios now is, from what we're seeing, and that there's a lot less competition. The cap rates aren't as compressed as multifamily. There's actually financing available. There's no Fannie or Freddie limit, but it's not for everyone. I can see why the institutions are still struggling to get in that particular space, because single family rentals are still fragmented. But where the numbers make sense and where those deals can satisfy what the investors' criteria are looking for, it ends up being a good match a lot of times.
So how big are your normal pool sizes on these single family home lots?
We're looking at a deal right now over in Tampa. It's about 69 houses. There's another. It's about 65 houses in Columbus, Ohio. And then we buy them in markets that we're already in. We can buy them one-off, onesie-twosies, or smaller packages from sellers that are just looking to retire. So it's more about where the numbers make sense. And another thing that I really appreciate that you do, and this would be a good tip for the listeners, when you're first getting a deal, just looking at the rent-to-value ratio. I don't think that's just exclusive to single family. I think that could apply to multifamily or office or anything else. If you have that criteria that you're looking for, if you know you want a 1% rent-to-value ratio, then it becomes a lot easier, to pass or take on deals that fit the criteria. So some of these deals, I mean, we go a little bit higher. I try to look for deals that are 1.5% to 3% rent to value ratio. And it does sound a little more challenging, but we manage them like apartment complexes. So we'll make sure we have the tenant retention systems in place, good management teams, and the main difference being that instead of one roof, we have multiple roofs.
Yeah, I just want to point out for the listeners that it sounds pretty amazing, but I know you're going after a little bit more C-class properties, $60,000 range, where I think kind of the gold standard that a lot of the listeners go after are that B- class, the $100,000 property that's right around that 1%. As you all know, it's that rent-to-value ratio changes as you go through classes.
Right, and it's definitely more management intensive once it gets a little bit higher, but. And that's kind of taking the experience we learned from the multifamily side of it. We see that with a lot of the sellers, unfortunately, where they buy at the wrong time, or they don't budget in repairs, maintenance, or capex, and they get surprised when they have to replace the roof or they have to replace the water heater and all that. But we factor that into the underwriting, and we're prepared for when it does happen.
Yeah, one thing I notice on these single family homes that is you can't really quantify when you're doing your underwriting is I feel like when you pick up the property, you get a lot of the systems fixed, and your CapEx is pretty smooth sailing for the first few years. But I feel like somewhere between year 4 and 8, it's gonna hit you hard, very hard. And what's your hold period on these portfolios?
Normally, most of them is as long as the investors, if this is what the investors are looking for that I'm involved with on the deal, it's a longer term, 5 to 7 years. But the goal is to be able to refinance it within the first 5 years and pull out as much equity as possible. What I did with the Phoenix properties, I refinanced and pulled out all the equity and the renovation budget. So literally had no principal into the deal and still had it cash flowing. So it's not a promise, but that's basically an infinite return then, right? You can do that on multifamily. You can do it on other asset classes too. So just, buying it at a discount, ideally buying below replacement cost, and being able to force equity in there through the renovations. I think that's a good strategy to go by.
Right. It'd be nice to check in with you and seeing when that wave comes, if it's a big tidal wave or it's just you underwrote it conservatively, I'm sure, to account for it. But it'd be interesting. I guess one thing I also see is, I see a lot of these pools of homes where, it's like a dozen properties here, 20 here, and a lot of them are just like crap. Like, just a bunch of lemons packed in a bag at Trader Joe's or something like that. It sounds like when you go above, 40, 50 units, that you seem to get a little bit better quality. Is that what you're noticing?
Yeah. And we say no to a lot more deals than we say yes to. We're seeing, the space is growing. And unfortunately, because there's an appetite for some of the REITs and the hedge funds in the space, some of the local turnkey providers, they'll take properties that they won't even appraise for more than $30,000, and they'll be selling them for $50,000 or $60,000, and they're trying to sell them the cash flow. And unfortunately, single family is not there yet. You can do that with multifamily, increasing the NOI and raising the value of the building, but single family, it's still associated with the comps. So we want to make sure that we're buying below the comps, just in case if the market just stays flat, that we have a good exit strategy in place.
So what's your thought on the hedge funds? I know they went in the early, 2010 to 2013, and they bought a lot of these areas like Atlanta, and now they've been holding them for a few years. I mean, what's happening with that inventory?
Yeah, they and I'm not a big fan of Wall Street, but they've actually done I think a good job in paving the way for this for the single family rental portfolio asset class. It's kind of a newer asset class. They created the financing, so they do a lot of the buying and the selling these big packages, but they've also created the companies that do the financing. B2R is one of them. I think they're changing their name, Civic Financial and Wedgwood and those so on. It's still fragmented though. I think at one of the IMN conferences I was at, they talked about how there's, I think it was like 11 million rental properties nationwide. I could be getting that stat off a little bit, but most of those 11 million rental properties, vast majority of those are owned by investors with 1 or 2 rental houses, or I think it's like 1 to 5. So the REITs that come in and they were buying up thousands and thousands of houses, but it's still a drop in the bathtub. It's still way too fragmented for them to be able to encapsulate all of the inventory on there. And a lot of times they don't like even the areas that we're in, at least in the current markets, we're not in the areas that the hedge funds are really going for. They're looking for the B and the A class. They don't really invest for cash flow. They're looking at more from a capital gains perspective. So we're more on like the blue collar working class cash flow focus. And when we can value add through renovations, we do that as well. So the same class but just different segments of the market.
All right, that's a great visualization. You're right below them. That's good. So we kind of talked a lot through your story, went quite along here, but I guess now you got a Chewbacca. Well, what's your worst life business moment? What did you do after?
Gosh, that was when and I didn't even know this was possible. That was when a bank tried foreclosing on an apartment complex that I owned, even though I'd never missed a mortgage payment. The way that deal was, that was a deal where the seller was hurting. The property was losing money every month. It was a larger complex in San Antonio, Texas. And we structured it with creative financing. So the bank knew that the property was in trouble, but the problem that we had was the seller was, they were very high net worth. And the bank's position was, okay, we have an inexperienced seller with a high net worth that's a guarantor on the loan. And then we have Sep over here who has a lower net worth and he has experience, so that we're trying to make it so we could assume the commercial loan and basically not have to put a down payment, because the numbers wouldn't have made sense if we'd have to put the 25% down at the price they wanted with the renovations required. So we structured it so that we assumed the commercial loan, the first position loan, and then the seller carried a second for the down payment. And I just paid the agent commissions on the side. So the bank, they knew that we were doing that. I was transparent, but it was kind of like, don't ask, don't tell. They said it's fine if it's on the lien, but don't send us an email about it or anything like that. So that was all fine. And then halfway through the repositioning, I mean, that property was extremely challenging. We've gone through 4 management companies on that one. That's the one that made it to nationwide news. And halfway through, it was actually after the second shooting on the property. The third shooting. The bank says, the representative from the bank that we're working with, the commercial loan officer, said this bank is actually being acquired by another bank because the bank is going under, in essence. So the new bank bought the old bank, and they were auditing all their loans, and they were basically anything that was done with any type of creative financing or anything that they didn't like, they would use any language they could in the loan documents to make it difficult. So we had a balloon on that seller financing that was coming up. That was in May of that year, and then December we had to pay off that seller financing. We needed more time. It was a lot more work. Like most repositionings, it takes longer than expected. It costs a lot more than expected. Seller was open to an extension, but the bank says, nope, we're not going to allow it. So they were doing what they could to force us into a corner of having to foreclose. And I think they saw that San Antonio market was improving. The building was worth a lot more than than what we'd bought it for. But thankfully, I mean, just with constantly just educating myself and going to networking events, we found an investor that was interested in taking out that seller financing without putting a lien on the property.
Did you get a lawyer involved? And did he just tell you were screwed?
Actually, it was Mauricio Raul, securities attorney. He's been phenomenal. So he helped us navigate that and be able to make it so that we can solve that problem. We ended up refinancing it afterwards, and the deal was awesome. It was a great learning experience, but it was not easy to go through because my number one priority was ensuring the tenant safety and giving the team on the ground all the resources they need to get the security cameras up, prevent the crime from furthering. And then the bank was just, making it extra more complicated. So, the mistake, the lesson learned from that was to make sure that in writing, that the bank does say something on there, like if there's any type of modification, anything creative with there, that they're okay with it, they sign off on it. Because unfortunately, email and word of mouth, it seems pretty obvious, right? If it can't happen, it will happen.
Yeah, get it in writing, always.
Right.
I always like at work, something we do at the day job is always follow up with an email saying, per our discussion, this is a summary of what we talked about. You don't need a reply. You just send it.
Right. Really good habit. That's a great habit.
The mark of a high performer is to put your ego aside and accept the help of others and mastermind. And I know you do this. You go to that goals seminar and you're always sitting in the front row. Me, on the other hand, I'm in the back so I can go to the bathroom or get coffee. So what's a 2-week experiment and a 6-month project you're working on to show people that you're actively working on new things?
The 2-week experiments, working on another acquisition, getting my own personal website up and running. The 6-month is to have the crowdfunding platform launched. It's myself, my partner Ryan, and our partners Ryan and Jacob. We're already syndicating, so I just feel like there's kind of a void in the crowdfunding market where it's a lot of these. A lot of middlemen, basically with little to no experience in actual syndications or actually having deals go bad and having to solve those problems. So I figure that there's a way to help other investors not make those same mistakes and be able to share their opportunity as well.
All right. The good thing about crowdfunding is now everybody can do it. The bad thing is that now everybody can do it, and you get
right.
Low barrier to entry is not a good thing, for the most part.
Exactly.
So any secret habits to share?
One recent one, I know you're a Tony Robbins fan, like myself. So I was actually at the Unleash the Power Within seminar in San Jose a couple months back. It was awesome. But Tony, he shared one particular habit that stuck with me. Even for all the listeners to do this, it's been really helpful because it's easy to become a deal junkie, especially if you're an active investor, just putting too much focus. One of the earlier podcasts you mentioned something about, it's not a good idea to just reinvest 100% of your profit from your deals. You should spend it, right? And I agree. I think that's a good philosophy to live by. So what Tony Robbins said is to take out a sheet of paper and draw on it a circle, and it's in that circle divided up into 7 or 8 spokes. So it's kind of like a wheel spoke. And in each section of the spoke, write down these 7 items. You can add more to it. One would be finances, then relationships, time, body, emotion, mission, and contribution. And then once you have those written in each segment, on a scale of 1 to 5, you would shade in that particular pie of the spoke of where you feel you are in personally for that particular spoke of your life. So, how do you feel about time management right now? Is it on a 1 to 5 on mission, on relationships and all that? And at the end, you'll notice, ideally it's supposed to be balanced, but at least for me, when I first did it, it was not balanced. I wasn't happy with my time management. I wasn't going to the gym as often as I wanted to. Finance was doing great, but there was some changes needed. So that's been a big help, just to make sure that we don't have any regrets later on in life. We're able to spend time with family or the charities that we're passionate about or whatever it is. So it's not just only about the next deal.
Yeah, my vision board, I have this quote. I think I made it actually. It says, anybody can achieve any one thing, but the truly successful can't have it all. And it comes down to balance. You see it all the time with these guys that go to the gym and they work out all the time, but they're broke. Or
right.
People who have all these friends and always have, dinner dates and lunch dates, yet they have just no direction.
Yeah.
You gotta
Too
have
much
it all.
focus.
Yeah, you gotta have the balance. And yeah, that reminded me of your story. You know, the famous Tony Robbins quote where he says, "Things happen to you, not for you." Right?
Right.
I mean, you had a couple of bad things that happened, and it definitely paved your way.
Yeah, and just taking it as a learning experience. I think school kind of gets us brainwashed into I'd say school and some of the corporate cultures sometimes. Unfortunately, it gets us thinking in terms of mistakes are bad. You know, don't make mistakes, get it right the first time. But I mean that's where the lesson is, and I think even when we take time to reflect on those mistakes and what we could have done differently, helps us get faster to the next level. So it's okay to mistake. I mean, just the faster we do it, the more often and smaller mistakes. I mean, we don't want to go bankrupt 20 times, but just being able to put those together and put that into the business, into the system, so that those challenges aren't as stressful anymore. I think it's a good way to make it so it's a lot less stressful for the investing. Even a lot of the challenges that I had earlier on, like those challenges don't happen anymore. Like the same deals, they would take a fraction amount of time to get them stabilized. It would take less money, and we wouldn't have all the turnover with the team because we have a process to be able to know what to look for and how to keep everyone accountable. But we wouldn't have known it unless actually putting the rubber to the road and start learning.
Right. The last time I went to UPW, the takeaway that I took was he said that the quality of your life is in direct proportion to the most uncertainty you can have. So, always try and take that next risk or fail or make that mistake.
That's a great quote. Love that.
But what's your simple passive cash flow now? And imagine you had 2 times it. Describe your ideal day, detailed routine, and what projects you'd be working on.
I guess the ultimate goal is to get it up to $50,000 a month in simple passive cash flow, and then if I doubled that to 100K, I travel more often. Gosh, daily routine. I'd go to Lake Como, Italy for 3 months of the year and just work over there with my fiance and have more time to coach other new investors, be able to improve more communities, basically. So just keep doing what I'm doing and just be able to change where I'm doing it from.
Something that you've recently thought about burning your cash on for a time savings or an improvement in quality of life?
Gosh, another good question. I think that improvement in quality of life, I think that's directly proportional to the value that we can add to others. So if I could burn the cash on hiring more employees, more virtual assistants, focus more on the online marketing, and maybe even build out an online financial education platform. And the ultimate goal is to be able to help teach and create 1,000 millionaires per year. Because again, I don't think school's doing a good job with that. I don't think the 401k industry is doing a good job, or Wall Street. So just trying to help educate more people who like me. I mean, I never thought I would be an entrepreneur. I didn't. I'm not for most of my life, I wasn't a big risk taker. I'm extremely shy, and I always thought that this, being a full-time real estate investor is something that happens once you're like in your 60s or 70s, but it's definitely possible. Just once you get around the right people, everything it's just like that compound effect. So I think I'd burn it more on expanding the business to help improve the lives of other people.
Yeah, I'm trying to do that, and want to go move back to Hawaii and start some kind of real estate club, but have it supplement like a nonprofit that teaches people how to keep a freaking budget and spend money and balance a checkbook. People still do that anymore.
Yeah, that reminds me of that old MBA saying, which I don't have an MBA, but you can't control what you don't measure, right? So just even just balancing the checkbook, if more people, I think, got in the habit of just doing that simple task, even just, what's one thing I can do to increase my income by $50 a month? What's one thing I can do to reduce my expenses by $50 a month? Slowly, day by day, that adds up. So instead of looking for the next $5,000 a month income or expense reduction, just little by little, I think you can get us all closer to that goal.
Yeah, it's always frustrated me how they teach all these subjects in school, but nobody teaches simple financial literacy.
Right.
And I think I think there's a crossover point with people, getting out of debt, managing a budget, paying off credit cards. But once they're up to a certain point, then they need to start doing the real estate. So I think that's kind of my big vision, is to get people out of debt and then transition into, let's do investing. But you can run the one in Southern California for me.
Sounds great.
Tony Robbins identifies two large concepts that we're continually struggling to gain perfection at. The first is the art of fulfillment, and the second is the science of achievement. If you died tomorrow and this was your final words of wisdom, what is your first secret of a science of achievement?
I think not necessarily having it be tied to money, and more about the lifestyle. The science of achievement, I think it's goal writing. It's the consistent habit of writing goals and sharing them with those who are supportive of those goals, and be able to keep each other accountable of those, and then just keep, even once you accomplish those goals, raise the bar even further. So add it again, and that's something I was reluctant to do even after I read, I think, Jim Rohn and Brian Tracy's books on goals, because it's like, well, how could something so simple make such a big difference in our lives, right? But it's insanely powerful. It's when it happens too, is I get shivers just, or goosebumps, just thinking about it. What's possible, right? When we apply that focus and that energy and say yes to the things that get us closer to that and no to the distractions, it just almost manifests itself naturally.
Yeah, it almost sounds oogity boogity, but Robert Helms said, don't analyze the roots, he just picks the fruit, right? If it works, it works. And all these other people are doing it.
Right.
I was like, Sep's up there writing his goals down and he's achieving it. Shit, I'm going to do the same thing. So we both went to the same goal seminar, and then they had us write down the first tier, second tier goals. How are you keeping yourself accountable? Are you looking at it every day or a weekly basis? Or maybe you kind of get into some of your best practices that you keep up on.
I've gotten a vision board, but I need to update it. But that's the first thing I see in the morning. Reviewing the goals. I'd like to do it every day. Now I do it about once a week. So that's one of the habits I need to change. I've been to Robert Helms' goal seminar twice. The most recent one was with you a couple weeks ago, and then the last time was about 4 years ago. And I think the difference between the two, at least for me with the goals and just keeping myself accountable, was when Robert asked everyone to write down, what is it that you hate most? Like what's the problem that in the world or in life or whatever it is, what is it that you despise? And it could be cancer, it could be a disease, or it could be a particular job, or whatever it is, something that we want to avoid. And then what is it that we're passionate about? He said, then write down what you're passionate about. And is there a way that we can merge those two together? And one of the things I wrote down that I hated was I hate seeing, especially during this last political cycle, I think a lot of people have unfortunately given up on capitalism because they think that these CEOs with these golden parachutes of these companies that they didn't start, they came in and they got big bonus even if they didn't add any value to the investors or to the customers or to the employees. I think that's what people associate capitalism with. So that was one of the things that I wanted to be able to change, was to help create more capitalists, to help create more financially free Americans or across the world as well. And that one of the goals was the crowdfunding platform. So we had already been working on it, but it just got that extra fire to be able to do that, to be able to help move more people into that financial education space and help give them more control of their life and their outcome.
You mentioned it before that one of your goals is to coach other entrepreneurs and real estate investors.
Right.
I know mine's is, what pisses me off is when I see these 35, 40-year-old couples with a 5-year-old, 10-year-old, and they're both going to their day job and they're just never really getting by. And I'm like, it's the stock market that's screwing them. And if they just had a little financial education on getting out of debt and investing, then one of them wouldn't have to work probably.
Yeah. Yeah, and that's true. It's inflation isn't making that any easier. The rising cost of living isn't helping with that either. I didn't see this. It was way before my time, but I've heard, like, the 1950s and 1960s, it was common to see single working. You'd have two parents, but only one of them would have to be working, and the other parent, either the husband or the wife, could take care of the kids. But now it's so rare to even see that, right? I mean, just one person working with the current wages, barely enough to even get by.
All right. So anything else that you want to leave on the art of fulfillment? I think you might have touched that already.
Yeah, I think just, keep being consistent with the goals, keep listening to the podcast, especially the Simple Passive Cash Flow. Keep absorbing the audiobooks too, even when life or work or whatever it is, it gets stressful. I feel like if you hear those audiobook recommendations too, write them down, listen to them, turn off the radio and try to minimize the TV if you can, and put more of those ideas into your daily routine to help you get closer to that goal. I think that's one of the key aspects of that science of achievement.
All right, anything we missed and any contact information for people to get a hold of you?
Yeah, the easiest way to get a hold of me, just on Facebook. So just my name, Sep Bekam. My website, we haven't launched it yet. And we also have a Facebook page called Real Estate Investing Quotes. And I get to share a lot of Lane's great quotes and the quotes from his other guests as well. So kind of a daily dose of motivation.
I'll email you my quote list. And you also have a meetup where you play Cashflow, right? How can people find that one?
Oh yeah, that's over in down here in Southern California. So it's two meetups actually: the Mission Viejo Cashflow Club and the Newport Beach Cashflow Club. So it's free to attend, and we'd love to have any of the local Simple Passive Cashflow listeners attend.
Well, thanks, Sep. I appreciate it.
That's my pleasure, Lane.
Right.
Thank you.
This website offers very general information concerning real estate for investment purposes. Every investor situation is unique. Always seek the services of licensed third-party appraisers and inspectors to verify the value and condition of any property you intend to purchase. Use the services of professional title and escrow companies and licensed tax, investment, and or legal advisor before relying on any information contained herein. Information is not guaranteed, as in every investment there is risk. The content found here is just my opinion, and things change, and I reserve the right to change my mind. Above all else, do your own analysis and think for yourself, because in the end, you are the only person who is going to look out for your best interests.